My name's Nate. I'm the founder of Token Dynamics. I'm going to be speaking about tokenomics for cypherpunks, how to build useful, valuable, and secure applications that are built to last forever. So a little bit about my background. I've been writing on tokenomics and related topics for the last 7 years on eatsleepcrypto.com. You can find all about value accrual, token utility, all these kinds of concepts that you're probably familiar with. I'm going to relate them to tokenomics today, and I'm going to speak about how tokenomics are slightly different for protocols that are designed for maximum censorship resistance. All right. So first of all, start off, what is tokenomics? There's been a lot of debate around the semantics of this word. I define tokenomics as token and economics. It's a portmanteau. It's shorter. I use it because it's short, not because it's the best descriptor. And it's going to be the Schelling point for what people call this in the future. But there are two parts to economics. It's supply and demand. And so often, people forget that they need to optimize the demand for their token to be used in the protocol and not just rely on artificial scarcity to pump the token price. So that's the foundation of what I call the demand-side tokenomics framework. And again, if you're interested in that, there are talks on YouTube. You can look up demand-side tokenomics. It'll come up. And I'm going to be building on that today, relating it specifically to how we as cypherpunks want to be building our applications. Okay, so if you've been in crypto for any amount of time, you've probably seen a graph that looks a little like this. As us, we get 99%, you get 1%. This is the scam pump and dump VC model that they all love. And so as cypherpunks, the thing I want to talk about today is how do we design things to bootstrap value from zero without having to go to these predatory models that are not democratic to raise funds or at least accrue value to a token retroactively. The first part of this is going to be the supply. So there are 3 points of supply-side tokenomics that I want to cover, and this is actually the easy part. So a lot of this you'll be familiar with. First thing in supply, emissions. The biggest question I get is, what should our emissions curve look like, or how do we issue our tokens, and like where do they all go, things like that. You can pick a number. I'll talk about this later. It's really like, the way I like to put it is, a token with a finite supply and no demand is worthless, but a token with a theoretically uncapped supply can still be valuable. You've got Dogecoin, you've got Monero. Dogecoin was a little more valuable, now it's more speculative, but we used to use it to transfer between exchanges because it had a short block time. So the other part of supply is incentives, and again, I'm going to talk a little bit about this later. Moving on to allocation, second point. What is the user-investor split? You're going to see stuff like this, the 99% and 1%. There's a wide range of bands that you can do in this. Like there's a wide range of team and investor and all these kinds of allocations. And so these are the kind of questions that I actually recommend people not get bogged down in. This is really the easy part, and there's a lot of precedent for what makes for a good allocation to users, to investors. The main thing you want to think about in this is the incentives. You want to ask, like, why are we giving people certain allocations, especially when you're coming from a blank slate. If you're building a protocol that is bootstrapping value from zero, you're not going to be beholden to VCs in the same way, and you can think objectively and critically about where your token supply is going and why. And then the last point, and I think the most important point of the supply side of tokenomics, is the distribution. So I've listed a few distribution mechanisms here. Make no mistake, proof of work is a distribution mechanism before it is a consensus mechanism. We needed Bitcoin to bootstrap to get it into the hands of people so that we could do more complex systems like proof of stake, or maybe not more complex, but different consensus models like proof of stake that relied on an existing distribution of tokens. ICOs were another popular distribution mechanism, a fantastic one, by the way, where they're going to make a comeback, airdrops, and so on. So these are the points of supply-side tokenomics. And But the overall goal so far for protocols has been manipulating the supply as sort of a pseudo-central bank in order to create artificial scarcity and pump the token price. And that is fundamentally predatory. It's something we avoid in our designs at Token Dynamics, and it's something I'm sharing with you because we're going to offer some solutions to that, some alternatives. And so this here, this triangle, is the tokenomics trilemma. It's made up of the three principles of demand-side tokenomics. So the first one is protocol utility. This is the value that you're creating. If you've read 0 to 1 by Peter Thiel, he talks about you want to maximize the value that you're creating in a creative monopoly where you are the only person doing whatever that is, and then you want to capture some of it. He uses the term value capture. I like value accrual. It's not as off-putting to people because it doesn't sound like you're stealing something from someone else. There is no fixed pie, so you can accrue value to a token in as many ways as you can create it. You can even accrue more value than you create, but that turns into a Ponzi, and I might get into that later. But the second point is value accrual, and so some people will call this token utility. The premise of demand-side tokenomics is to use a token in a way that causes it to accrue value and generates demand for it from the use of the protocol. So you don't just want to create something valuable, you also want to accrue value by using the token in that protocol in a certain way. And we're going to talk about some examples, but I'm outlining the high level first. The third point of demand-side tokenomics is economic security, which is fundamentally incentive alignment. Economic security, technical security is a lack of bugs in the code. Economic security is a lack of bugs in the incentives. So you want to have aligned incentives all the way around. And what I'll talk about is there are actually trade-offs between these three things, which is why it makes for a good framework in thinking about your protocol design. The high level here is demand-side tokenomics maximizes users' demand for a token, not speculative demand for a token. And so as cypherpunks, when we're creating these protocols that are coming out of nowhere like Bitcoin, we need to have good economic models that are going to bootstrap value automatically rather than asking people to buy in on a concept and then later dumping 1% of the token supply and liquidating the entire AMM or order book to zero. And so the capstone property here that you get emergently if you optimize for all three of these is what VCs call defensibility. So it's basically the economic moats that your protocol has that allow it to sustain itself long term with a competitive advantage. And in our world, we're thinking about the kind of economic incentives, financial alignments that you can make that allow it to survive without additional help or upgrades from the team. So we're really thinking of this holistically, and I think defensibility is the right way to define that for us. And the other point that I wanted to make a note of is cypherpunks need to accrue value because if you're building anything important, you're gonna have people after you. You might have legal battles to fight. You might be Tornado Cash founder. You might be building something that really needs value accrual. And if you don't have that, you're relying on the goodwill of your community, and that is not fundamentally as sustainable as just accruing value to the token fundamentally by inserting it in a way that captures some value in the protocol. Getting some claps here. Love it. Okay, so let's see. Did we skip ahead? No. Okay, so I want to talk about distribution a little bit here. Yeah, I might actually talk about this later. I'm going to skip back to the slide. Let's go here. So the tokenomics trilemma. Like I talked about, there are trade-offs between these three things. It's what makes this trilemma a good way to think about things is you can optimize for two at the cost of the third. And so the main objective is to optimize for all three using some creative mechanism design, some tokenomic mechanism or game theory that you're inserting into your protocol that solves for each of these points. So the first example I like to use is Uniswap. The first time I started using this was like a few years ago. They were talking about the fee switch. they're still talking about the fee switch. This week, they're talking about the fee switch. And they're basically saying, are we going to take money from users and charge them more? Or are we going to take money from LPs and cut into their already negative margins? And this is a byproduct of Uniswap's failure to capture value initially. So you can see they actually have a lot of economic security. There are no token price dependencies on Uni in the Uniswap protocol beyond their front end and the very few things that they vote on. But they struggle between protocol utility and value accrual. So there's a trade-off there. Second example, Terra Luna. Classic token price dependency was what both caused it to accrue a ton of value because you needed Luna to use the protocol for everything, and it also compromised it because there was a token price dependency. So there's this inherent trade-off between a lot of tokenomic mechanisms around value accrual and economic security. Synthetics is another example, and they recently stepped down their value accrual by allowing people to mint SUSD with Ethereum as collateral. So they weren't quite as overweighted like Luna was with Anchor on UST, and they are able to just be the substrate, collateral asset for all of the synths in their ecosystem. So they're actually stepping down their value accrual in order to get more economic security. Third example, Bitcoin. Bitcoin has a security problem. It's a crisis, and it's kind of slow motion, and it's been ongoing for years. We've all seen it coming. They now have, they're confronting the possibility that they might not have enough fees to pay for their security, to pay miners to keep hashing on Bitcoin. They have three options. They can either raise the block size, do a tail emission. So raising the block size, they've shown very reluctant to do, right? We went through the block wars 7 years ago, 7 and 9 years ago. They could do a tail emission, or they could move to proof of stake. And so right now, they're kind of threatening users with less security, and users meaning individual users, protocols that are appending transactions and using Bitcoin as an L1, various types of users. They are trading those users' economic security or usefulness in the protocol with their design, and so they're compromising their economic security. It's a trade-off between protocol utility and economic security. Okay, so practically, generating demand for a token in your protocol. Generally, in a protocol design, you can think of a protocol like a marketplace between multiple groups of users. So say you have Alice, Bob, and Charlie, and Alice wants milk, Bob wants eggs, Bob wants chickens, and each of them have one of the other things that the other has. This is called a coincidence of wants in economics, and it's supposedly the reason money was created, but no one really knows the history of money. But the idea here is that a protocol can disintermediate a central solver. And so any protocol that you would build will have this kind of coincidence of wants. You can think of it very simply, stack up the list of things that people on one side have, list of things that other people on another side want, and then you strategically insert some mercenary user that you pay with something from the excess of the have side, and then you optimize the protocol with some kind of mechanism to facilitate this kind of market. And the essential questions that you're going to ask here are, who can you charge? So who's willing to pay, right? And who has the money to pay for things? Who do you need to pay to do things? And by what mechanism are you actually organizing everybody in the protocol? And so this gets into the concept of tokenomic mechanisms. So these are ways that a token can be inserted into a protocol that cause that token to accrue value that is also doing something useful in the protocol, that is providing a missing piece in this solver optimization sort of marketplace model. I want to talk about there's actually a kind of a good direct mapping to the kinds of assets we already have in traditional finance. So mechanisms and tokens are going to more or less resemble three asset classes from traditional finance. These are equities, commodities, and currencies. And thankfully, there are already precedents for how to value these things. So if you look up online, you can see, how do I value a currency? How do I value an equity? Or how do I value a commodity? A little more hairy there, but we'll talk about it. So first example, Tornado Cash took a 0.3% fee from transactions, and it accrued it to the treasury. And you can value Tornado, or could have valued Tornado when they had a treasury, using a discounted cash flows model. But this is kind of like a, just a service-based business charging a fee. And you can model it like a company that has regular revenues. It's just a very straightforward way to accrue value to a token. And this is the thing everybody's been avoiding because of regulation, which we'll also talk about later. But that's maybe the most direct way that you can accrue value to a token. And it's a great one. There's nothing wrong with it. It's fantastic, especially if you're bootstrapping from zero and you have no reason to fear US regulators, which we'll also talk about in a little bit. Maker is also equity-like. So the Maker token has a buyback and burn system, basically like an equity. It's a lot like paying a dividend or buying back a share of stock. It's just technically not that. So both of these are valued similarly to equities. You can use as discounted cash flows, and then you have a couple frills in your models to account for the different behavior of tokens. But basically, I don't think I mentioned this before, but the any model that you have is going to track the ways that the token is used and account for that in the model itself. So it might not be directly a discounted cash flows model when you're thinking about how much is this token worth, but it's going to look a lot like it. Second is commodity-like. So you look at the best substitute for this when you're trying to understand how value accrues to this token. And again, these are helpful mental models for designing a token. It's not necessarily going to tell you what the price is at any given time, but with adjustable assumptions, you can zero in pretty close to what the intrinsic value of a token is, and that's what we're concerned with, because there are what I call price floors, and I've written about extensively, the minimum possible value for a token to sustain long term. And that's what designing things to resemble TradFi assets will do. It'll give you an actual minimum price based on its use in the protocol. I'm going to show that with the currency-like. I might do a sample calculation, but with commodity-like tokens and mechanisms, BTC, supposed to be digital gold. You can use the closest analog of gold and say if BTC had 10 times this market cap, what would each, or 10% of this market cap, what would each Bitcoin be worth? That will give you, some number that you can use to approximate what BTC is worth. And if you're considering a commodity-like mechanism in your protocol, then you can compare how the commodity-like mechanism would accrue value as opposed to the equity-like mechanism that you're considering. And the most useful information in designing a token and designing a protocol is going to be the comparison between these mechanisms rather than the actual information and price that you get on the other side. I have an asterisk here next to ETH, because ETH, people like to say, is digital oil, but it's actually not really, because there's a gas market. So ETH has sort of turned itself, and it has each of these three properties, but it's turned itself into, or has been from the beginning, a currency for a small market of block space. And they've also become, the ETH token has also become blue chip collateral in ETH-based DeFi, so it's got some currency-like properties. It also pays out a dividend, so it has some equity-like properties, but fundamentally, it's bootstrapping from something like a currency. And I have written at the bottom here, standalone gas tokens are not that valuable. They're actually just currencies for a really small particular market. And when you have a digital commodity like block space or something like that, that is more or less fungible between chains, like for the end user, they're not particularly caring whether something is on Ethereum or Bitcoin or wherever else. It's not going to accrue that much value to make your token just a gas token. So that's another question I field a lot is, can we just build this as a gas token and expect that it becomes valuable? Well, maybe from like a speculative standpoint, but not fundamentally. And so the third asset class that tokens and the mechanisms they use tend to resemble are currencies. Currencies can be valued with a thing called the equation of exchange, which is just mathematical notation for the idea or the axiom that a currency has to be worth at least as much as the things that it buys. So if you have a currency that's really private and really good for, really liquid in certain markets like the dark web, this currency is going to be worth in aggregate the value of all the goods that it's paying for, accounting for that each unit might be spent multiple times. That's called velocity, and that's a part of the equation of exchange. So this is where we see in practice the strongest price floors. Monero has been slowly trending up in keeping with adoption over time, and I've been saying for the last couple years that it's because of this property. It's the currency-like mechanism. It's that Monero is used as a currency. And so as its adoption and saturation of the market both increase, it is increasing in value steadily, and there are some other factors on the supply side that I won't get into that are keeping it more stable as well. Synthetics, another currency-like token. It's used as collateral for synths, so the fundamental value of SNX is proportional to the demand for synthetic assets that are built on it. And so it's used as a medium of exchange for, buying synthetic assets, or a medium of exchange as collateral for these synthetic assets. Okay, so back to supply side. I have Monero up here. Supply doesn't really matter that much. People get caught up on like how much supply should we issue? What's the number? Is it 100 million, 200 million? And the answer is pick your favorite. It doesn't really matter that much. Monero has a tail emission. There is an infinite number of Monero that will ever be minted. As long as Monero is online, it's going to infinity. The key is that the demand is outpacing the supply. So that's what you want to be thinking about when you're trying to design an economic policy. The emissions curve also doesn't matter a ton. It's just whether you get the adoption right. And so a static emission curve is actually probably not the best, because who are we to forecast how quickly somebody will adopt our protocol or our token? Satoshi had no competitors, so it didn't matter that he said, let's have it, the emissions every 4 years. He could just do what he wanted. He had a blank canvas. But the point is, don't stress too much about supply. Allocation is much more important. And I have this blunt question, like, why are you giving away tokens? And that is both rhetorical and literal. Like, I want to ask, why are you giving away tokens? Because there can be good reasons to give away tokens. You want to think about the incentives that the people you're giving those tokens have to hold it. And again, if you're integrating the token with some kind of tokenomic mechanism, then people are going to want to hold it because they need to in order to use your protocol. The challenges for protocols like StepN, for example, come in when nobody wants to hold the token. They've just given it away to everybody, third world token farmers who are dumping them to pay their bills for their next meal. You don't want to do that. So you have to have really good reasons to think about why you're giving tokens away to people, especially when you don't have to give them to VCs who are going to demand exit liquidity and things like that and put a lot of stress on your protocol and your token price. So distribution, the third point of supply-side tokenomics. Tushar Jain from Multicoin Capital has a really interesting take that new markets or bull market cycles are kicked off by, or at least frenzies are kicked off by, a new distribution mechanism. And so these are kind of the metas that have been for the last 10 years. But proof of work was dominant until 2015 when people realized what crypto was, and the early adopters got in, that 13% of the early adopters. Then ICOs in 2017, initial DEX offerings and initial exchange offerings in 2019. Airdrops became a meta for token farmers in 2021, carried over into points in 2023. And I'm going to talk a little bit about what 2025 might hold. But before that, I want to loop back around to this. Nope, that's that. Generating demand. Got it. Okay. So we have a really interesting turn of events this week. The regulatory conditions have changed in the US. We were heading one way, we're now maybe heading another. And so the sitting president of the United States in 3 months will own a crypto lending market. That, I don't know exactly how bullish that is, but it's not bearish. And it also has implications for bootstrapping value to your token, raising. It has actually a lot to do with the democratization of access to capital. And so we'll start with some of the pros here. We might actually have sane regulators who are willing to hear some of the arguments that are made for crypto. The first crypto wars, if you remember, in the 90s, were won through U.S. Regulation by leveraging the law in the United States. And that was because the US had a functioning court system. We now have someone going into office whose supporters, at least, are all very in favor of a functioning court system. And all the signs seem to me that this is going to change the degree to which US politicians are following the laws that they purport to. So we may get an administration that is favorable to crypto. I don't like the idea that cypherpunks wait for favorable regulatory conditions. I think that's silly, but I do think that it's worth considering that maybe the most anti-establishment thing we can do is take advantage of the conditions that exist right now. On the con side, to the counter argument here is his cabinet's going to be full of VCs, and VCs don't want to democratize access to capital. And so while we may have the opportunity to work within the US regulatory system in the next couple of years, there's probably going to be some pushback, and people are going to want KYC and proving that that people investing are accredited investors or whatever. So there are some potential downsides ahead regulatorily as well. And furthermore, the looser the regulations, the weaker the ecosystem. The more strict the regulations, will push DeFi to become better in an evolutionary way long term. We're not going to have that opportunity anymore, which is both a pro and a con. So, distribution, and this is going to be the practical bit here that I'm going to leave you with. I see 3 main distribution mechanisms. We've talked about how to bootstrap value to your token. Now we're going to talk about the practical ways that you can issue a token that are going to work especially well with a demand-side tokenomic framework. The first is a return to ICOs. So Maddie Tokenomics has a really great protocol called Legion. It's ICOs 2.0. And I would recommend people check it out if any of you are thinking about raising or bootstrapping capital. This is a good sort of more regulatorily safe way to go about it. And these are going to go from compliant to what I call a-compliant, without the need to comply from left to right. But a return to ICOs is a trend that I'm looking forward to seeing as a token economist. Second is auction primitives. So Factory DAO has a really cool auction. It has a binary search mechanism that allows you to approximate the actual or the fair market value of a token while bootstrapping it. This is another fantastic option, and it's moving more toward the a-compliant side, which is not needing to comply because you're not breaking any rules. It's a more agorist approach. And the third is what I call zombie forks. So a zombie fork, you're familiar with a vampire fork. SushiSwap did this extremely well in 2019, 2020, early OG DeFi. They still have liquidity. SushiSwap is still the main LP pool for several blue chip assets. So that's incredible. All they had to do was promise people tokens. So a zombie fork is something a little different, but in the theme of mythical monsters. There are hundreds of thousands, if not millions, of tokens out there where the whole supply is like just hanging out in a liquidity pool. Nobody's doing anything with them, and these tokens exist. You can just use those tokens in your protocol. There's nothing stopping you from doing this. And with demand-side tokenomics, you can bootstrap value directly to those tokens. So if you have a good demand for your token and for your protocol, you can just pick another token and use that. So these are kind of A-compliant strategies that we're pioneering at Token Dynamics. We're doing R&D on this kind of stuff. We're putting our resources into this. And if these kinds of things are interesting to you, or if demand-side tokenomics is something you'd like to explore, you can reach out to me. This is my link tree, and you guys will be able to reach out to me here. And you can find us on Twitter at Token Dynamics. All right, any questions? We might be, if we have time.
We can do one. Yeah, we got one here. Yeah.
I mean, I've probably got a bunch, but just because you touched on SushiSwap, do you want to, obviously I know what happened with SushiSwap, do you want to like say more about like the path, the curve of Sushi after it was initially issued?
Yeah, I mean, which part of it would you like me to speak to? I don't know that I have even the expertise that you do, actually. I'm curious what you're thinking I'll touch on.
Well, I guess I'm personally interested in how doable like vampire attacks are and different kind of vampire attacks. And so, what did it look like? Was it like a big burst of like everybody loves sushi because that was a burst you needed to get it off the ground, or was it like a slow burn? Or
I think the opportunity for SushiSwap is kind of past. I think vampire attacks are really difficult. Although, yeah, so to sort of answer that question, I think SushiSwap worked because people were frenzied about airdrops. And back in the time of like yield farming and the food token era of all of these tokens that were just named after food, that kind of approach worked because people had a legitimate expectation that those tokens would be going up in value in the near future. You would need the same kind of frenzied conditions to pull off a vampire fork now. But I think it's still possible, and as we go into what is potentially another bull market, there might be the opportunity to vampire attack things again. I'm not sure whether SushiSwap could have succeeded today, for example. But something I have seen with another vampire fork that people don't actually know too much about is Tether against USDC. So Tether charges a 0.1% redemption fee, but they waive it for themselves. So they can keep people from redeeming Tether while anytime the market dips on the Tether to USDC pair, they're able to buy up USDC cheaply, redeem it for Tether, and arbitrage that 0.01%. So we are still seeing vampire attacks, but it's slimmer and slimmer margins. So that maybe could answer the question, but I don't know that I could speak to the particular curve of Sushi and how they executed it. I have to do a full case study. It'd be super interesting.
I mean, that was a more interesting answer, to be honest. I had to keep talking about it, but obviously we've got to stop.
Yeah, let's keep. Yeah, for sure. I'll find you after. Yeah, thanks.
Thank you.
All right. Thank you, guys.
Thank you, Nate.